You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines. Because what matters isn't only what happened, it's what happens next. Let's begin. What happened? US stocks have rebounded as the dual pressures of rising bond yields and elevated oil prices began to ease. This shift follows a period of heightened volatility, where investors grew increasingly cautious about the Federal Reserve's stance on interest rates and the broader economic outlook. The bond market, which had been a significant source of concern, saw yields stabilize, reducing the immediate threat of higher borrowing costs for businesses and consumers. Simultaneously, oil prices retreated from recent highs, alleviating fears of inflationary pressures spiraling out of control. Who does it affect? This rebound touches nearly every corner of the financial landscape, but its impact is uneven. For retail investors, the stabilization of bond yields means less pressure on mortgage rates and personal loans, which could ease the financial strain on households still grappling with high living costs. Small and mid-sized businesses, which often rely on short-term borrowing, may find it slightly easier to access credit, potentially supporting hiring and expansion plans. Large corporations, particularly those in energy-sensitive sectors, stand to benefit from lower oil prices, which could improve profit margins and reduce operational costs. However, the relief may be temporary if underlying economic uncertainties persist. Pension funds and institutional investors, who had been adjusting portfolios to hedge against bond market volatility, may now reconsider their strategies, potentially shifting allocations back toward equities. For policymakers, the rebound offers a momentary respite, but it also underscores the delicate balance the Federal Reserve must strike between controlling inflation and supporting economic growth. What should we watch next? The first watch point is the Federal Reserve's next move. While bond yields have stabilized, the central bank's signals about future rate hikes or cuts will be critical in determining whether this rebound has staying power. Investors should pay close attention to upcoming economic data, particularly inflation reports and employment figures, as these will shape the Fed's decisions. The second watch point is oil prices. Geopolitical tensions in key oil-producing regions, such as the Middle East, could reignite volatility if supply disruptions occur. Additionally, the upcoming OPEC+ meeting could result in production cuts or increases, further influencing global oil prices. The third watch point is corporate earnings. Smart money. Neutral. Smart money is adopting a wait-and-see approach, recognizing that while the immediate pressures have eased, the underlying economic landscape remains uncertain. Institutional investors are likely to maintain a balanced portfolio, avoiding overcommitment to equities until there is clearer evidence of sustained stability. The stabilization of bond yields is a positive sign, but smart money understands that yields could quickly reverse if inflation data surprises to the upside or if the Federal Reserve signals a more aggressive stance on rates. Oil prices, too, are a wild card. While they have retreated, geopolitical risks could push them higher again, reigniting inflation fears. Smart money is also closely monitoring the US dollar, as its strength or weakness will influence everything from corporate earnings to global trade flows. For now, the cautious approach means reducing exposure to highly leveraged sectors and favoring companies with strong balance sheets and resilient cash flows. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis, Monday to Friday.